What have we learned? The first batch of U.S. economic data is out. It doesn't seem to suggest that the Fed is in a position to cut interest rates. Stock markets go down, as one might have surmised from such an outcome. So is this just clear-cut, easy going, or is there more than meets the eye here? That's what we're going to try to figure out on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And it's been a very, shall we say, emotional kind of a day in markets. Not a lot of participation. Volume's relatively weak here, but lots of up and down. And after what looked like a bunch of inconclusive seesawing, the markets ultimately resolve lower. So we'll start here with a look at the economic data and the performance response there too. We'll see what markets did, and then try to figure out what's actually going on here and what we have learned from the interesting sort of setup here now emerging, not just in the stock market and not just in the major assets, but really across the board. It does seem like there is a narrative emerging here. We're going to try to figure out what that is. So here's today's performance. NASDAQ ultimately shaves its gains down to nothing. S&P comes off 0.4% by the time all is said and done. We get a little bit of a rise in the front end of the yield curve while the back end comes down, as if to suggest that Fed rate cut odds weakened a little bit in the near term, but more easing than what went into the long end. That seems to be consistent with how we've been thinking about this. The Fed has been resistant to cut and has demanded more evidence. And so we've concluded that maybe the long end is going to be a little bit soggy on the yields front and outperform a little bit on the prices front as more easing goes into the back end. Today's response to the data seems to echo that. Crude oil down again, but still basically scraping the bottom of its longer-term range, not really breaking into new territory here. Gold correcting a little bit, but ultimately not crossing any Rubicons and seems to be more so digesting after what has been a potent rebound over the past several days, down 0.7%. The US dollar, though, it's looking meaningfully perkier. 0.1% gain against the euro and the yen doesn't look big, but it is starting to become something of a string here. Dollar's been inching up for a few days straight. And that's going to be something to watch. And Bitcoin fails at December's range high. That's the range high that we've been talking about since last week, saying it looks like Bitcoin's holiday period melt up just ran into where resistance was. And if it couldn't get over that, then the trend was still down. And today we get some confirmation that it really couldn't run over it. And we come back and essentially erase all of the January 5th upside gap at the start of the year and come back to right around where prices were drifting in the last week of December and through the New Year's holiday into where we closed on January 2nd. So not the most heroic day for risk sentiment here. Let's take a look at the data. We find here that the service sector boomed according to the ISM numbers in December. Very sharp rebound, as ever this is done in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So we start the week with the manufacturing numbers. We've talked about those. They end up looking like a slightly faster contraction than anticipated, 47.9 versus 48.3. but ultimately no big surprises there. The firepower came today from the service sector report, and I've added this little dashed line here, which is a guesstimate at what a composite taking in services and manufacturing would look like. That composite is 70% services, 30% manufacturing, which is a kind of back of the envelope breakdown for the shares of each sector in the US economy. Obviously, it's not exactly this because there's also agriculture that makes up for a tiny part of what's going on. But overall, this is sort of a general idea of where the economy is trending. And what we find here is when you take this together, the expectation as it stood with an ISM of 52.3 on the services side was for the weakest growth in 3 months. Now, that would have been down from a 9-month high in the prior month, so not exactly the world's scariest thing. But what we end up with is actually much more dramatic. We end up with the strongest growth since February of last year. So what we're looking at in December is a 10-month high on this composite index. What we're looking at for the service sector, which of course powered all of this, is actually the highest reading since October 2024 and a 14-month high. It gets more interesting still. Employment returned to growth. You can see this green employment index is back above the 50 line, which means that it is now back into growth territory. It had a brief pop into positive territory in May of last year, and only then very, very narrowly. The last time that we had anything like this kind of employment growth in the service sector was October of 2024. And so this makes it another 14-month high, this time on employment growth. On the inflation side, we can see things cooled a little bit more. New orders surging. To put this bit in context, that's a 57.9 on that index, and that's the strongest since September 2024. Of course, the end of 2024 was a very vigorous year, or a very vigorous period, rather. In fact, that whole second half of 2024 was a very vigorous period for the U.S. economy. And so that's a 15-month high on new orders growth. Now, lest you go into the mindset of, and everybody was worried about the tariffs, don't forget this is the service sector. Most U.S. services demand is a domestic conversation. Those services are mainly a domestically serviced sort of economic activity. It's domestic firms that handle it. And so whatever this resilience is, it's happening despite whatever may be happening on the goods side, and independent of it, maybe, or perhaps just more spending is going in this direction. It's something that we're going to have to keep figuring out as far as what the impetus for this kind of outperformance is. But we can clearly see the difference between that and where the tariffs are a factor. This is the manufacturing side, again, published earlier in the week, where we've had contraction for months and months here, going all the way back to the beginning of the year last year. You can see there was a very brief period of positive growth, but generally the manufacturing sector has been deep into contraction territory for quite some time now. And we can see employment and new orders looking quite negative, basically since the middle of last year for new orders and going all the way back basically to the start of the year last year for employment. So where does this leave the Fed calculus? Well, taking together the price indexes for both surveys, the Fed's argument that inflation is going to cool and that the reacceleration we've seen recently is more so a tariffs thing and that will fade away, that seems to be there for the most part. Inflation is, in fact, cooling. But on the employment side of things, it's difficult to make the Fed's argument. Because while employment in manufacturing is certainly very weak, as we just saw, employment in services has jumped significantly, and services employs the overwhelming majority of the U.S. economy, somewhere between 70 and 80%. So with that, how easy is it going to be for the Fed to say, well, it's sogginess in the labor market. That's why we're cutting rates. Doesn't seem to make sense if this is what's going on. So surely then the markets clawed back Fed rate cut expectations, and surely then we are looking at an economy that's unexpectedly strong as far as the markets are concerned. Perhaps inflation might even perk up. Well, not so fast. Because if we look at the policy outlook here, it's barely budged. We are still looking for 56 basis points in rate cuts this year. Next year looks like it's flat as far as the markets are concerned. So we've got 2 rate cuts between now and the end of 2027, but the markets want all of them to happen this year and, frankly, sooner rather than later. We don't have a meaningful expectation that we're going to get a cut in January. See here, we're down to 11.6%. That's down from where this has been over even just the recent days, but not meaningfully so. It's off from maybe 16%, 14% down to 11. So it's not exactly a meaningful change. But we can see here the markets want their cuts, and they want them for the most part toward the first half of the year. That second cut on the menu narrowly for July, but you can see here the math is getting real close. So if you look here, that's 47.8% chance that we hold still. So it's narrowly over 50% that we're going to get a hike, but only very narrowly. And so let's call it a hike or a cut rather, no later than September. Narrowly in July, but no later than September. And before that, a cut convincingly on the menu by April. So the markets think that this is not exactly going to take until the end of the year as it did in 2025. They think the easing's coming. And that's despite this buoyant growth. Meanwhile, the Fed certainly seems to be looking like things are evolving in a way that makes sense from their perspective. In December, they increased growth expectations all around. We can see here from this ISM data some evidence helping to support that argument. We also see, interestingly, that the Fed increased and decreased sort of different parts of what you might think would be parallel moves, because though we get an upgrade in growth, we get a downgrade in inflation expectations, which perhaps the Fed is reasoning is going to be a base effect type of thing as the tariffs get factored out of year-on-year calculations. Maybe that's why we are looking at this cut in April and not sooner, because it seems like that's the magic point where data starts to get out of year-on-year comparisons with a pre-tariff period. Of course, early April was the big rollout of the tariffs. They subsequently haven't survived in the same form, but that was really the first month where things looked meaningfully hairy and started to show up in expectations and started to really rattle markets. So perhaps this is why April is the day or the meeting that the markets are looking at. But still, what the Fed is looking at here is only one cut for this year and one cut next. So it agrees with the markets ultimately that there's going to be 50 basis points in easing this year and next year, but the Fed's got them spaced out one cut per year. And the markets have a much greater sense of urgency. Now, we've seen just how this lines up with stock market performance. The Fed came out in October, late October. This was the October 29th Fed meeting right here. And this was where Powell forcefully came out and said, you all are over extrapolating rate cut expectations. We are not on autopilot. You all are wrong. Stop it. And since then, the stock market hasn't really gone anywhere. Moreover, this has lined up with the stasis that we've seen in this policy outlook. So the Fed is telling the markets, don't overdo it. The markets have taken the cue, perhaps, to stop extrapolating into ever more dovish territory, but they've certainly not come off their square here. They're still calling for more easing this year than was on the menu for the Fed. So, and the markets clearly don't like that. They clearly want the easing. So what gives here? You'd think that after such explosive data, you'd get a meaningful pop in inflation expectations, but they're not really here. Moreover, I mean, I suppose there's a little bit of a wiggle here, but this looks like a wiggle within the confines of a downtrend going all the way back to July, August. So inflation expectations aren't really running away. And frankly, the strange thing here is that for how buoyant the ISM numbers look, they're not out of step. The third quarter GDP report showed us a very brisk rebound in consumption, which is by far the largest component of GDP at something on the order of 68%. Moreover, all of these shenanigans with the swings in inventories and imports around the front running of the tariffs, they go away. We get a much more normal quarter in the third quarter, driven primarily by consumption, which is what you want to see. A different version of PMI numbers, this one from S&P Global that was confirmed here this week for December. It's a little bit less optimistic. It shows a little bit of a cooling in activity in the fourth quarter. Not surprising, perhaps, since we had the long government shutdown there. But even here, even on this pessimistic view, we're only at about the midpoint for what has been average growth once things sort of equalized post-COVID. We had a big rush to catch up on the way out of lockdowns. Then there was a kind of give back here where things evened out after all of this overexertion. And this was kind of the range for growth that we've carved out since. Where we land in December is right around the middle. So certainly nothing controversial, even though it is soggier than what the ISM numbers are showing us, which is, we can see here, clearly more chipper. So why aren't the markets baking in more inflation? Why aren't they taking down Fed rate cut expectations? Surely at some point it's disappointing, but the data and the Fed seem to agree, so why fight it? Well, if we take a look at the makeup of the 10-year yield here for a clue, we find that yields have rebounded some and are now holding sort of near this 5% mark here for a while. We find likewise that quote unquote real yields, that is excluding inflation expectations, are there with the headline, so it's not some sort of aberration. Moreover, we can see that inflation expectations have actually come down even more recently here. So the markets don't seem to be pricing in a whole lot of inflation, but the term premium, a measure of compensation for duration in these bonds, that is to say, how much do markets want to get paid for lending money longer term and to be compensated for the extra uncertainty over a longer period of time. That looks to be at the highest since 2014. So we're looking here at a 22-year high on this measure of compensation for uncertainty in the benchmark risk-free asset, the 10-year U.S. Treasury bond. What is it that the markets are so afraid of? Is this why they want rate cuts? Because they perceive a lot of uncertainty? Maybe. Maybe they just want the cheap money there so that if something goes wrong, never mind what, if something goes wrong, then you have cheap money to protect yourself so that if you wipe out on some of your risk exposure, you can go back and borrow cheaper and go again. Well, perhaps this, as we've been talking about, is the issue. We can see here that obviously last year, the major point of consternation was the rollout of the tariffs. In fact, as this spike in the trade policy uncertainty index was appearing, stock markets had erased all of their 2024 rally just between February and April of last year. They then had to rebound to reclaim all of what they retraced. So they had to basically do 2024 in a time-crunched way again, and then set higher highs. But we can see here, even as this uncertainty about trade policy seemed to diminish, the amount of fuzz around the averages here, the level of volatility, is clearly very elevated relative to even where it was on the way to and during COVID. And of course, trade policy is pretty uncertain here in the sense that we have lockdowns. Even on the way out of the lockdowns here, it doesn't get meaningfully more uncertain. This is tightly wound around the 7-day and the 30-day moving average. Clearly not so here. So even though the overall levels have come down, the level of uncertainty around the trend is very elevated. And the results, in 2025, we had a meaningful slowdown in global trade volumes. In fact, the most aggressive one in year-on-year percent change terms since the 08-09 global financial crisis, worse than COVID. So why is it that the markets want protection? Well, ostensibly because what this uncertainty leading to a decline in global trade does is it attacks the main underpinnings for what has been driving the market higher. And that's, of course, tech and AI optimism. We can see its contribution is head and shoulders above everything else for the S&P 500. Meanwhile, the supply chain for it is very globally dispersed. There are almost equal weighted pieces here, meaning that we have a very distributed supply chain whereby if even one node falls off, the whole thing starts to look very precarious indeed. And trade policy uncertainty does not make for a happy life here. So perhaps the markets don't even know what they are afraid of. They just know that things are uncertain and they're afraid. And what they want are rate cuts. And when they look at explosive data like this, they don't say, oh, goody, earnings, strong growth. Perhaps what they're saying is, we're still going to need these rate cuts. And this doesn't move inflation expectations. So is this growth real? Is it a mirage? Or are the markets just very vulnerable? Because they clearly seem to still want easing and still see no meaningful inflation downwind. Now, of course, this is just survey data, this ISM report, but we are going to get some hard data confirmations of all of this as U.S. jobs data comes across the wires on Friday. We'll get deeper into that tomorrow and unpick it here on Macro Money. In the meantime, I'm still long gold around all of this uncertainty around global trade. I think if the Fed continues to tarry, the U.S. dollar might start to look stronger, if only because people want their liquidity and want more cash on hand. So if you're going to backstop yourself, you might as well have the cash if it's not going to be cheaper to borrow it. So I am now long the dollar against both the pound and the euro. I flipped over the euro earlier this week. I flipped over the pound just today. I'm likewise still on the short side of risk via Russell and the NASDAQ and the S&P with put verticals. I was coming up on expiration for the last little bit of my put spreads in IBIT, betting on Bitcoin weakness. And I took that off today, basically flat, after peeling off all of the profits on this late last year. And I'll be looking to re-enter, just perhaps with a little bit more confirmation that the downtrend has resumed in earnest. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I am likewise writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.